So good evening everyone. So in the morning session we discussed relating to accounting treatment for business combination. So accounting treatment for business combination, how we are taken, Nana? So initially, first of all, business combination will occur only when an entity acquires the control of the business of another entity. So they should acquire a control of the business of another entity. Control can be acquired in three types: more than 50% of stakes, compose the board of directors, direct the relevant activities. In these three stages we can attain a control. Acquirer company will attain a control, majority of stakes, composing the board of directors of acquiring company, at the same time direct the relevant activities of acquiring company. So then we are getting the control. So here control over the business means there should be some business exist in the acquiring company. So business, here we are discussed about three integrated activities should be there. One is input, processes and output. Okay, so then after we discussed relating to acquisition method, how to do accounting for business combination under acquisition method. Ind AS 103 gave the guidelines. We have to follow the following guidelines, the stepwise guidelines they have given. In the broad standard itself it is given. First of all, we have to identify the acquirer. So identify the acquirer means which acquirer, Nana? Identify the accounting acquirer. Identify the accounting acquirer. Next one, identification of or determination of date of acquisition. So determination of date of acquisition. And third one is determination of purchase consideration. So identifying the acquirer means which acquirer we have to identify? Accounting acquirer. So we are having legal acquirer also. So generally the person who acquires the business of another entity, we can call it as acquirer, but legal point of view he is the acquirer. But we have to check, we have to do accounting. Accounting means we need accounting point of view who is the acquirer. Most of the cases legal acquirer will be the accounting acquirer, and some cases like reverse acquisition, accounting acquirer will be different. Accounting acquirer will be different. Legal acquiree sometimes will be the accounting acquirer. So that we discussed in the morning. And second one, Nana, determination of date of acquisition. So date of acquisition, how can you determine? Generally, in which date acquirer attains a control of the business of another entity, we can say that date will be the date of acquisition. In some condition, if any government approval is required, so the date of approval by the government, in which date the government gave the approval, that date we will consider as date of acquisition. And third one, determination of purchase consideration. So generally purchase consideration they will give you in the question itself, until and unless. So we can compute the purchase consideration also in the following ways. So we have taken how much cash you paid for consideration, plus if you give any equity shares, the fair value of equity shares we have to take. I am giving equity shares in my company, the face value is 10 rupees. Okay, but what is in the market? In the market, what is the value of my equity share? For example, this 10 rupees share in the market, it is traded for 100, then 100 will be the fair value. 100 will be the fair value. In the market, what is the trading price? That we have to take it into consideration. Fair values we have taken into consideration. Fair value of equity shares given to the acquiree. Fair value of equity shares given to the acquiree. And fair value of assets transferred. If you transfer any assets as a part of purchase consideration, you are giving some assets. The asset value in your books of accounts, it is carrying amount, but that amount we should not consider. What is the fair value of that particular assets? What is the fair value of that particular assets? On the market, on the spot, if you sell the asset, how much you will get? That we call it as fair value. We have to consider the fair value of assets only. Okay, the fair value of assets transferred. And equity shares also fair value. Debentures also, Nana. If you give debentures as a part of purchase consideration, you are giving debentures of your company. Acquirer company is giving the debentures of acquirer company to the acquiring company as a part of purchase consideration. We have to consider what is the fair value of that debentures. In our company, each debenture is 100 rupees, but in the market price is how much for that debentures? It is also 100, means we will take 100. If it is traded for 120, means we have to take 120. If it is traded for 80, means we have to consider 80. The fair value of debentures issued, that will be taken into consideration. And two types of consideration additionally we are having. One is deferred consideration, another one is contingent consideration. If any deferred consideration is there, deferred consideration means at present we are not paying, but in the future date we are paying. So after 2 years I will pay 5 lakhs. So he told that, so here I'm paying this much right now, and after 2 years, remaining 5 lakhs I will pay. What is the present value of that 5 lakhs? We have to take it into consideration. Present value of deferred consideration. Don't worry, Nana, we will do some problems on deferred consideration also. Okay, so deferred consideration and contingent consideration, how we have to recognize the provisions, that we will do it. So when it comes, I have included that problems also in our material. And contingent consideration also we have to recognize that fair value. Contingent consideration means if you are giving, so anything like for as a part of consideration, you are saying that after 5 years, after 3 years or after 5 years, I will give you this fixed number of shares. 10,000 equity shares of my company I will give you after 5 years. After 5 years, you are giving our company shares of 5,000 or 10,000 shares. Fixed number of shares we are giving means what is the value of that shares? We don't know what is the market value after 5 years. We don't know at present. So it is a contingency in nature. That consideration we can call it as contingent consideration. The fair value we will determine based on estimations that we will recognize at present value. So that we call it as purchase consideration calculation. Purchase consideration calculation. These are the things will be considered, and some more elements are there. So that we will discuss when time comes. So just like if any, have you know about share-based payments? Share-based payment. So share-based payment reserve, if anything is there, that also will be considered. So when we discussed about Ind AS 102, there we can discuss about share-based payments properly. Okay, so that I have not included here. So because we are at the initial level, so what is required for us, that only we are going to study. So one by one we are going to deal. So that is about the purchase consideration, determination of purchase consideration. So take the next point. So take the next point, Nana. Fourth step. Identifying the net assets. Identifying the net assets taken over of acquiring company by acquirer company. So identifying the net assets taken over by acquiring company by acquired companies. Of acquiring company means, see here, we are taking the net assets. X Limited purchased Y Limited business. So X Limited is taken over all the net assets. Net assets means assets taken over and liabilities taken over. So what are the assets we have to take and what are the liabilities we have to take? Assets taken over, what are the things, and liabilities taken over, what are the things? So assets taken over or liabilities taken over, at which value we have to take? That is the major point, because Y Limited balance sheet, all the assets and liabilities are recorded at their carrying amounts. So at their balance sheet values. These are the book values. These are the book values of assets and liabilities. These are the book values of assets and liabilities of which company, Nana? Y Limited company. Now these assets and liabilities we are taken over. When we are taken over under acquisition method, we have to taken over at their fair value on the date of acquisition. On the date of acquisition, we are finding the date of acquisition. No, on that date of acquisition, what is the fair value of the assets taken over? What is the fair value of the liabilities taken over? Okay. So that is the point. First, you have to identify which assets we are taking and which liabilities we are taking. Identifiable assets and identifiable liabilities. Have you remember when we discussed about amalgamation? So identifiable assets, identifiable liabilities. Identifiable assets means here not only the assets which is there in the balance sheet of acquiring company, some of the assets which is not recognized by the acquiring company, that also we have taken into consideration. So what are the things, what are the exceptions of that recognitions, all we can study one by one. So identification of net assets taken over by the acquiring company, sorry, taken over by the acquirer company. Net assets of which company? Net assets of the acquiring company taken over by acquirer company. So first you have to identify what are the assets taken over, what are the liabilities taken over. So next, fifth step, after identifying that, fifth point, all the assets and liabilities all the assets and liabilities of the acquiring company all the assets and liabilities. Nana, here liabilities means outside liabilities only. So everywhere we are considering liabilities means outside liabilities. It does not involve equity elements. Share capital will not included. Reserves and surplus also will not included. So here liabilities means outside liabilities. So all the assets and liabilities of acquiring company shall be taken over at fair values. At fair values, very, very important point. At fair values on the date of acquisition. Fair values on the date of acquisition, underline that point. All the assets and liabilities of acquiring company shall be taken over at fair values on the date of acquisition. On the date of acquisition, what is the fair value? Okay. So first of all, what is the step one? Identifying the acquirer. Second one, determination of date of acquisition. Third one, determination of purchase consideration. Fourth one, identification of net assets of the acquiring company. And fifth one, all the assets and liabilities taken over at fair value on which date? On the date of acquisition. On the date of acquisition. Okay. So now here in the assets, some of the assets are there. I told you at the time of introduction session, non-current assets held for sale. Non-current assets held for sale. So generally non-current assets used in the business means, I told you, it is property, plant and equipment. Non-current assets we are using in the business means that is property, plant and equipment. Ind AS 16 will apply. If any non-current assets are there in your balance sheet which is not for use it in the business, which is held for sale, which is held for sale. If any non-current assets are there held for sale, not using the business means some days you used and ready to sell. Okay, sometimes it will be like that. Or it is not giving any future economic benefits for you. We are stopped doing operations. So here such kind of assets are there which we are not using it in the business, which is held for sale, ready for sale. So in such condition, how to be consider such assets? Okay, simply in the balance sheet of acquiring company, some non-current assets are there which is held for sale. So for this, we have a separate accounting standard, Ind accounting standard, Ind AS 105, which deals with non-current assets held for sale. Non-current assets held for sale, separate standard we are having. For example, I told you for fixed assets, simply in format for our language, we can say non-current assets are fixed assets. Fixed assets used in the business means we have Ind AS 16 property, plant and equipment. If the same fixed assets held for sale means we have separate standard in Ind AS, that is Ind AS 105. Ind AS 105 deals with non-current assets held for sale and discontinuing the operations. There's a separate standard. But while going to accounting standard 10 we are having. Accounting standard 10 deals with both the assets used in the business, both the assets held for sale. Single standard there. But here we are having a separate standard for non-current assets held for sale. So non-current assets held for sale as per Ind AS 105, we have to recognize that fair value less cost of disposal. Fair value less cost of disposal, which is nothing but on the spot, if you sell that particular asset, how much you are getting minus how much expenses you incurred to sell that asset. How much expenses you incur to dispose that asset, that is cost of disposal. One machinery I am having, it is held for sale. On the spot I sell the machinery, I will get 1 lakh rupees. On the spot, if I sell the machinery, I will get 1 lakh rupees. To sell that asset, I will incur 10,000 rupees expenses. To sell that asset, so I incurred some sales commission to the brokers or whatever the thing. So transportation or whatever the thing. So the cost of disposal is 10,000. So the net value, how much, Nana? 90,000. So we will recognize that 90,000 here. Okay. So sixth point, write it down. Non-current assets held for sale. Non-current assets held for sale of the acquiry company non-current assets held for sale of the acquiry company shall be taken over at now, if any such assets are there in acquiring company balance sheet, we have to take an over at fair value less cost of disposal. Fair value less cost of disposal. Fair value less cost of disposal. This is as per Ind AS 105. Ind AS 105, which deals with non-current assets held for sale and discontinuing operations. And discontinued operations. So discontinued operation means till now we are using that, but we are stopped using that asset. We are stopped using that asset. We are not using that asset for operational purpose. Such assets. Okay. So properly you can understand about this accounting relating to non-current assets held for sale in property, plant and equipment. When we are discussing about property, plant and equipment, so we will discuss about this element also. Okay. So, but acquisition purpose, if any non-current asset held for sale is there in the acquiring company's balance sheet, that we have to take over. That also we have to take over along with all the assets. But the fair value less cost of disposal, that net value we have taken into consideration. So that is one point. So that is about the sixth point. Next. Okay, completed, Anna. Now, if acquiring company having any intangible assets, that intangible assets also we have taken into consideration. That intangible assets also we have to take over. We are taken over all the assets, and outside liabilities, as I told you, all the assets excluding fictitious assets minus outside liabilities. Intangible assets are fictitious assets? No, intangible assets are not fictitious assets. So there is a value assets. It is a valued assets. Fictitious assets means valueless assets. Okay, we cannot sell that fictitious asset to recognize the money or to realize the money. Okay, it is valueless assets, but intangible assets are valuable assets. So when you are acquiring intangible assets, if any intangible asset is not recognized by the acquiring company, not recognized by the acquiring company, okay, so that also we have to recognize, by taking into consideration. That means intangible assets, we have a separate standard, Ind AS 38. Okay, as per Ind AS 38, it meets that intangible assets meets recognition criteria. As per Ind AS 38, you have to record that, but you are not recorded in your financial statements. That means as per Ind AS 38 intangible asset, some intangible assets have to be meet the recognition principle. We're having recognition principle, measurement principle, disclosure principles, like that for every Ind AS. So as per Ind AS 38, it have to be recognized, but not recognized by the acquiree. Which is not recognized by the acquiree means which is not there in the balance sheet of acquiree. Such assets also we have taken into consideration at fair value. So on the date of acquisition, what is the fair value of the assets which is not recognized by the acquiree? Intangible assets which is not recognized by the acquiree. But as per Ind AS 38, it having the recognition principle. It meets the recognition principle as per Ind AS 38. Such assets also will taken into consideration. For example, see here in the balance sheet of acquiree, some intangible assets are there. Okay, some assets they did not recognize, not recognized means for example, like internal generated goodwill. Have you heard about that? Self generated goodwill or something. So generally self generated goodwill we should not recognize in the balance sheet. Only purchased goodwill have to be recognized. But while coming to acquisition, that self generated goodwill also we have taken into consideration, which is not recognized by the acquiree, because it is internally generated. Okay, because it is internally generated. So as per Ind AS 38, that is also meets the recognition principle, recognition criteria as per Ind AS 38, which is not recognized by acquiree. Such intangible assets also we have taken into consideration at fair value on the date of acquisition. So such intangible assets also we have to consider, okay, which is not there in the books of acquiree, but still at the time we are identifying that assets as identifiable assets. So we have to recognize, we have to taken over such assets also at which value? At fair value on the date of acquisition. So got the point, Nana? Okay, Ind AS 38 ప్రకారం కొన్ని ఇంటాంజిబుల్ అసెట్స్ని రికగ్నైజ్ చేయాలి, కానీ ఎక్వైరీ ఆ అసెట్స్ని రికగ్నైజ్ చేయలేదు. సో వాడి ఇంటెన్షన్ ఏంటంటే బికాస్ హీ ఇంటెండెడ్ దాట్ ఇట్ ఈస్ ఇంటర్నలీ జనరేటెడ్, సో ఐఎమ్ నాట్ రికగ్నైజింగ్. బట్ స్టిల్ ఎట్ ద టైమ్ ఆఫ్ ఎక్విజిషన్ సచ్ కైండ్ ఆఫ్ అసెట్స్ విచ్ ఇస్ నాట్ రికగ్నైజ్డ్ బై ద ఎక్వైరీ ఆల్సో taken over at fair value on the date of acquisition. What is the fair value? That value we have taken into consideration. That is the 7th point. So write down intangible assets that meets recognition criteria that meets intangible asset that meets recognition criteria as per Ind AS 38. Nana, Ind AS 38 means intangible assets. So we have a separate chapter for Ind AS 38 also. So we will do accounting Ind AS 38 also. So intangible asset that meets recognition criteria as per Ind AS 38 intangible asset, comma, but not recorded by but not recorded by acquiry company, but not recorded by acquiry company, shall also be taken over, shall also be taken over by acquirer company, shall also be taken over by acquirer company, and shall be recognized at which value? Recognized at fair value. On which date? Date of acquisition. Recognized at fair value on the date of acquisition. On the date of acquisition. Example, internally generated goodwill. Patents, customer relationships, etc. Patents, customer relationships, etc. And patents means here generally we are doing some research and development and we are taking patent on our that work. That means it is sometimes will be under research stage, sometimes it is under after research under development stage. So whatever the stage it might be, so here if any patents are there, that is also internally generated by the company. So because of their research and development, they got patents. Such things also, if it is not recognized by the acquiree, but we have to recognize that at the time of acquisition on the fair value on the date of acquisition. So once you go through that point, intangible asset that meets the recognition criteria as per Ind AS 38, but not recorded by acquiring company, shall also be taken over by acquirer company at fair value on the date of acquisition. Okay, Nana? So we discussed what? Non-current assets held for sale. Non-current assets held for sale are there in the acquiring company's balance sheet. So that also will be taken over at fair value less cost of disposal. At the same time, for intangible assets, if anything is there, which meets the recognition criteria as per Ind AS 38, but which is not recorded by acquiree, what is not recorded by acquiree, that also to be taken into consideration, taken over at fair value on the date of acquisition. Okay, so these are the rules. Actually all the things will comes in the problem means no. Okay, so these are the rules as per Ind AS 103 for every differentiation. So regarding the assets, every confusion relating to the acquisition, so they have given this certain rules. Okay, so next one, contingent liabilities. Acquiring company having contingent liabilities, there may be a chance. So there is a contingent liabilities for acquiring company. Once you are acquiring the business of acquiring company, you have to take that contingent liabilities also. That contingent liabilities also will be taken into consideration. That is also taken into consideration at fair value on the date of acquisition. So here contingent liabilities will be recognized by the acquiree or sometimes not recognized by the acquiree. It depends upon the probability of outflow of cash. Have you remembered that? So we are having Ind AS 37. Ind AS 37 deals with contingent liabilities and contingent assets. Provisions, contingent liabilities and contingent assets. Ind AS 37. We don't have in our syllabus, but as per Ind AS 37, if there is any probability of outflow, then only we can record that contingent liabilities. If probability of outflow is not there, no need to record. But still here, when we are taking, if any contingent liability is there, if any contingent liability is there for acquiry company, we should not check any probability. Contingent liability is there means that should be recognized in the acquisition. So that is relating to contingent liability. So contingent liability, Nana, have you understood what is contingent liability? The liability which may happen or may not happen in the future. It is an uncertain event. It is based on future uncertain event. Okay, so regarding the contingent liabilities also, we have a separate cases there, we can study about that. Okay, so that we will discuss when we are having pre-existing relationship before acquisition and after acquisition. We are having a concept called pre-existing relationship between acquirer and acquiree. So pre-existing means before business combination they are having some relationship. So regarding relationship means here what? Not that relationship. So relationship means here sometimes acquirer may file a case against acquiring. Acquirer filed a case against acquiree, so that case is pending in the court. Okay, so it based on some amount should be receivable from the acquiree. So that flow is a contingent liability for acquiree. Okay, so acquirer X Limited file a case on Y Limited. Okay, so for the receipt of some cash. Okay, so it is under the court. If court judgment under the favor of acquirer means that is a liability compulsory have to paid by the acquiree to acquirer. Okay, in certain conditions, or if the court is giving favorable judgments towards the acquiree means no need to pay. So that is a contingent liability for acquiree. Yes. How to do accounting in the business combination, certain kinds of pre-existing relationship. We have a separate model of questions for that. So there we will discuss over there. Okay. So here if any contingent liabilities are there for acquiring company, that should be recognized. That should be recognized at fair value. Taken over at fair value. Sorry down. Contingent liabilities. Contingent liabilities of acquiree. Contingent liabilities of acquiree shall also be taken over. Contingent liabilities of acquiree shall also be taken over and recognized at fair value. Again, fair value on the date of acquisition. Fair value on the date of acquisition. So check all the points. Nana. In the 8 points, any doubt in any point you can raise. Yeah. Edana? If you give preferences, that also will be considered. So any shares, preference shares will be given as a purchase consideration. That also will be considered fair value. Generally, most of the acquisition we are going through equity shares. So okay, Nana. So contingent liability is also taken over at which value? Fair value on the date of acquisition. See, next, have you heard about indemnification assets? Indemnification asset. So indemnification asset. Okay. So here, for example, A Limited is an acquirer company, B Limited is the acquiring company. A Limited is the acquirer company, B Limited is the acquiring company. So here in the B Limited balance sheet, listen, contingent liability 10 lakhs is there. So in the B Limited balance sheet, contingent liability 10 lakhs is there. As I told you, we have to take into consideration the contingent liability also. For time being, the fair value of contingent liability is also 10 lakhs. Okay. So now, who have to pay this 10 lakhs? If that liability arises, A Limited have to pay that. It is loss for A Limited. It is loss for A Limited. So A Limited will ask B Limited, is there any probability here? If I have to pay this 10 lakhs, it is loss for me. So B Limited is saying that no doubt it won't be a liability for you. Okay. So he is assuring that it won't be a liability for you, pakka. Okay. But after some years, when it becomes a liability, it is loss for A Limited. Okay. So that A Limited will say what? I don't have any trust on you. Okay. So I want some compensation relating to this asset. Okay. So the compensation, he's saying that, B Limited is saying that, okay, if it is becomes a liability for you, if it is becomes a present liability for you or probable liability for you, okay, so then I will pay 5 lakhs. Then I will pay 5 lakhs. So that means 5 lakhs he will compensate. Remaining 5 lakhs is loss for A Limited. So A is saying that it is unfair. Okay, it is not my liability. I have to pay your liability. So they're bargaining. So they come to 6 lakhs. So A is not accepted. 7 lakhs. A is not accepted. 8 lakhs. A is not accepted. Okay. Now B Limited got angry. B Limited got angry and saying that, so you won't trust me. Okay. So if that liability arises, I will give you 20 lakhs. Confidence. ఈ సల కప్ నమ్దే. Okay. Wait. So here he's having a confidence that, listen, whatever the amount compensating by B Limited, whatever the amount compensating by B Limited, acquiring company, that will be an asset for acquirer company. So who is compensating? B. That is a receivable amount. That is a receivable amount from acquiring company to acquirer company. It is an asset, Nana. Yes, that compensation asset we can call it as indemnification asset. So indemnification asset will be recognized. So if he is giving 5 lakhs, we will record indemnification asset 5 lakhs. Okay. So contingent liability 10 lakhs, but indemnification asset 5 lakhs. What is net liability? 5 lakhs. So if we indemnify 6 lakhs, 4 lakhs, 8 lakhs. So 10 lakhs, Nana. So 10 lakhs he is compensating, means no problem. Okay. So he is saying that what? 20 lakhs. But still we have to record maximum 10 lakhs. Okay. So if he indemnify 20 lakhs also, but recognition purpose, maximum, it should not exceed the contingent liability. It should not exceed the contingent liability. Indemnification asset should not exceed the contingent liability. If he is paying 20 lakhs also, we have to recognize maximum how much, Nana? 10 lakhs. So indemnification assets also will be recognized if anything is there like that. Okay. So indemnification asset, which is nothing but acquirer is promising to pay such amount based on that contingent liability. He will compensate that amount. Indemnification is nothing but compensation. Okay. So that indemnification asset also will be recognized at the time of acquisition. So that is the 9th point. Now you understand what is indemnification asset? Yes. Indemnification asset. Indemnification asset promised by acquiring company indemnification asset promised by acquiring company also be taken over, or you can write shall also be taken over. Shall also be taken over. So that is also comes under assets taken over. Okay, if any indemnification asset is there, that also to be considered as assets taken over. So indemnification asset means, Nana, the asset which is compensated, the amount which is compensated by acquirer to the acquirer regarding contingent liability. So indemnification asset promised by acquirer shall also be taken over. However, such asset cannot be recognized at a value in excess of contingent liability. In excess of contingent liability. If contingent liability is 10 lakhs, means maximum indemnification asset is how much? 10 lakhs. So if contingent liability 8 lakhs, means maximum indemnification asset 8 lakhs. It should not exceed the contingent liability. If he promised also, we should not recognize such amount. So here for for normal understanding, you can write down A Limited B Limited is acquirer, is acquiree. So acquiree having contingent liability, 10 lakhs. Contingent liability 10 lakhs. Now these contingent liability will be taken over, Nana. By whom? How much? 10 lakhs. 10 lakhs. Now acquiree is compensating. So how can you make indemnifies 2 lakhs. Indemnification how much? 2 lakhs. Then what is the indemnification asset here? 2 lakhs is the indemnification asset. So here you can write maximum 10 lakhs to be recognized. So this 2 lakhs only he is indemnifying. That means if any contingent liability is probable to pay by the A Limited, B Limited will compensate how much? 2 lakhs. So remaining 8 lakhs have to pay by the A Limited from his pocket. Okay. So that 2 lakhs maximum, how much you can recognize that? Maximum indemnification must be 10 lakhs. It should not exceed the contingent liability. It should not exceed the contingent liability. So here we discussed about indemnification asset. Indemnification asset also recognized here. Indemnification asset also recognized. So it should not exceed what, Nana? It should not exceed the contingent liability. That point you have to remember. So that is the important point. It should not exceed the contingent liability. So only one last point we are having for this. So step 1, identification of acquirer. Second one, date of acquisition. Third one, purchase consideration. Fourth one, identification of net assets. And next one, assets should be recognized at fair value on the date of acquisition. So assets and liabilities will be recognized at the fair value on the date of acquisition. Sixth point, non-current assets held for sale, if anything is there in the acquiry, should be recognized at fair value less cost of disposal as per Ind AS 105. Okay, next one, intangible assets, which is recognition under the criteria of Ind AS 38 but not recorded by the acquiree, should be taken over by the acquirer at fair value on the date of acquisition. Next point, Nana. Contingent liabilities, if anything is there in acquiring company, that should be taken over by acquirer at fair value. So on that contingent liability, if any indemnification asset is there, that also to be recognized, but it should not exceed the contingent liability. This is all the rules of Ind AS 103 business combination under acquisition method. Okay, so problems are very quite easy. Okay, when you understand the pattern, so it will be easy to do the problems. So rather than the accounting standard. Okay, simply, Nana, accounting standards are rule based standards. Okay, so rules means you have to follow that. Okay, you have to follow the rule. One rule they have given means you have to follow that. Okay, sometimes no logics also. Okay, we have to follow that. While coming to Ind AS, these all are principle based standards. These are not rule based standards, principles based standards. So we have to follow a certain principles to do the problems. So that's why most of the things Ind AS will be under practical in nature. Okay, so when you are going for any firms or companies in future, you can see they will follow the Ind AS patterns of accounting only. So the real pattern of accounting. So generally accounting standards, whatever we are following, we are studying is different. What is going in the accounting is different. Practical. Okay. So while coming to Ind AS, the same thing will be there. What you are going to study here, the same pattern will be there for the financial statements. If you check for a companies which is there in the present scenario, those are following Ind accounting standards. So directly we are following the principle basis of accounting. So not like rule based. Okay, so in the not only here in India, every country they are switching from old rule based accounting to principle based accounting. Okay, so they have switched over rule based. Initially what they are following, they switched to so principle based accounting. So all over the cases, all over the companies. Okay, including government accounting. Okay, so we're having separate chapter for government accounting, there we can discuss. Okay, it is not yet fully implemented in India. Okay, but still we are following the rule based only, but they are intended, they proposed some standards, it is yet to be notified. Okay, so that we will discuss in government accounting. Last point right down here. Nana, if any 5 minutes ఉంది కదా ఒక point. Okay, if any reacquired rights are there, for example, acquirer giving his patent rights or any intellectual property rights to the acquiree. Okay, so before business combination itself, before business combination, acquirer is giving some licenses rights or franchise rights so to the acquiree. Now the business combination is happened, now all the assets and liabilities will be taken over. So that means whatever the rights you have given to the acquiree, you have taken back that rights. So that the right to license, right of franchisee, anything is given. Okay, so here X Limited is acquirer, Y Limited is the acquiree. Okay, before business combination, X Limited giving some licenses to Y Limited, some franchise rights to Y Limited, some intangible assets to Y Limited, some patent rights to Y Limited. Now Y Limited is doing the business based on the licenses given by X Limited. Now, when the Y Limited entirely purchased by X Limited, Y Limited, all the assets and liabilities will be transferred to X Limited. Now that patent rights, whatever they are using, used patent rights, right of use patent rights, so such things will also be taken over by X Limited. So that we call it as reacquired rights. Reacquired rights. That means initially rights given by acquirer company to acquiree company. Now they are reacquiring that. When they are having that reacquired rights, that also to be recognized at fair value on the date of acquisition. Fair value on the date of acquisition. For example, X Limited giving license to Y Limited for 10 lakhs. Okay, so for 10 years, 10 lakhs license for 10 years. 3 years already used by Y Limited. 3 years already used by Y Limited. Now what is the value? In general we can say 3 years means each year 1 lakh if you amortize. Each year 1 lakh if you amortize. How much balance will be there? 7 lakhs balance. Now we have to reacquire this 7 lakhs. That means what is the fair value of that particular right we have to consider. On that value we will reacquire the rights. Okay, so that is what here the things. So relating to leases, have you heard about right of use of assets? In the same way, right of use of intangible assets. Right of use of intangible assets, just like franchise rights or any license rights is given by the acquirer to the acquiree, the same rights is reacquired by the acquirer from the acquiree. Such reacquired rights also will be taken over at fair value on the date of acquisition. So that is the last point here. So what is meant by reacquired rights? The rights which once already given to the acquiree, again it is reacquiring by the acquirer. So reacquired rights. Like licenses, franchise rights, etc. appearing in the books of acquiring company. Reacquired rights like licenses, franchises, etc. are in the books of acquiring company shall also be taken over. Taken over at fair value on the date of acquisition. Okay, Nana. So this 10 points which is there already in your material, but for proper way to understand it better, I gave the notes. So this is very important. Acquisition method, the heart of the problems in acquisition method, we will follow these steps. Okay. So these 10 steps, once you go through it, okay, just rough revision, you can make it. And tomorrow onwards, we will discuss about the problematic part relating to that from the model wise. So here we divided the business combination problems model wise. Okay. So in certain model, which type of model they will give you. Okay. For that particular model, how to do the problem. So like that model wise accounting aspects, accounting problems we have given under business combination. We will start model 1 tomorrow. Okay. So have you understand the points? Any doubt in that you can ask later. Thank you.